Good morning and welcome to today's webcast, Tax Reform ASC 740 Requirements. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only one sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you everyone for joining us today, and I'm happy to introduce today's presenters, Andy Cates, National Tax Partner, ASC Topic 740, and Casey Moore, Senior Manager, Tax. And with that, Andy, I will turn the line over to you to get us started.
Thanks, Emily. Yes, today we're going to be covering Topic 740, tax provisions and accounting for them in financial statements. We've tried to select the areas that are going to be of immediate interest to companies and people trying to prepare their tax provisions in the current quarter or annual, depending on your situation. So our agenda today is that we'll go over the major impacts we think are relevant that tax reform caused for ASC 740. We'll go over the U.S. corporate rate reduction and how that impacts companies on an annual and a fiscal year basis. And we'll also cover what that means for interim reporting. We have, each one of those has a different approach, and so we'll get into that. One of the major changes is that alternative minimum tax, AMT, was repealed for corporations, and so there'll be some transition adjustments there and how to account for the transition in the provision. The Act also modified net operating losses and how those are treated. And one of the things that readers have noted is that there's different effective rates for those different NOL changes, effective dates. And so we'll go through that, but that makes a difference in how you prepare the tax provision. We'll get into valuation allowances. One of the characteristics that are significant now is that some of the NOLs are permanent. There's some new timing differences. And so valuation allowances will have to be looked at, again, in view of all those changes. International was a landscape change, and we have a detailed webcast to go into all the international changes. But in this session, we'll get into and talk about what immediate considerations you should be taking and maybe some of the specific items that impact the provision. And then finally, the financial statement disclosures, because of the change, will need to be different. And those will be, specific to a company. We'll discuss what the SEC has recommended as kind of an interim approach to getting the full impacts of the Tax Reform Act included in the financial statements. And as of this morning, the FASB is meeting to discuss whether ASC 740, the standard itself, might need to get updated or provide some additional guidance for non-public companies. So quite a bit to cover. We put in a couple of examples, and so we'll get right into it. So tax reform created a lot of changes, and one of the rules in ASC 740 is that the effect of any change in tax law is recorded discretely as a component of income tax expense in continuing operations in the period of enactment. And there's a lot that goes into that sentence, but discretely is an important piece of it. Your rate reconciliation or the entry in the quarter is impacted for the period of enactment. And the period of enactment is when the President signs the act into law. Now, that can be a little bit different for IFRS. IFRS might have viewed it that once it passed the House and the Senate and it was substantively changed, it could be recorded in that period. That discussion ended when the President signed it on the 22nd. And so we think both for IFRS and for U.S. GAAP, it'll be falling in the period that ends with the date of enactment of December 22nd, 2017. Now, one of the interesting parts of ASC 740 is that when there is a change like this, that all remeasurement established for that goes through the P&L. And that includes deferred taxes that were recorded previously somewhere else. Banks and insurance companies specifically have brought this up, that they have significant balances in OCI. And what this means is that if they record a reduction in the corporate rate and reduce their deferred taxes through the P&L, there will be what they refer to as a dangling credit or a debit sitting in OCI, and that's causing some concern, which coincidentally is also one of the topics that the FASB is discussing today. So it may be that we get additional guidance coming, but right now, all the measurement goes through continuing operations and the P&L. And so any annual or interim tax provision ending with that period of enactment within that statement needs to incorporate the effects. And so we'll get into some of the mechanics. The tax reform is also, I mentioned earlier, having a major impact on U.S. and international accounting. And for the international accounting in particular, there's several remeasurements. There's elections to treat operating losses and credits one way versus another. There's timing for payments. And there's also the indirect effects of some intercompany reporting that will need to be considered in light of one of the new taxes that were introduced, the base erosion and tax avoidance tax, which acts like a minimum tax. And I'll touch on that later. So for all of these changes, an incredible amount of work that needs to get done, and public companies have a very short window to file. And so what the SEC did is they put out a release, Staff Accounting Bulletin 118, and they said that due to the compressed time frame, companies can take a provisional approach so they can get the material items in there, acknowledging that it would be nearly impossible for some companies to get all the effects incorporated into their provision. And we'll go over later what those disclosures that have to accompany this look like, because if there's a provisional approach, then obviously at some point after that, those provisional account amounts would need to be corrected. And another thing to note, that is also, there's 3 or 4 topics that the FASB is discussing today. This is also one of them. This was specific guidance for public companies, but we may see similar guidance coming out for non-public companies. And then finally, the valuation allowance. We've had a fairly standard approach to many of the ways we evaluate the need for a valuation allowance, but given the significant changes caused by the Act, there will be a need to forecast where perhaps the need wasn't there before because of expiring tax attributes. The scheduling of deferred taxes will be important. Some of the provisions make things permanent, others sunset or are over an interim period. And so all of these new changes will need to be incorporated in that evaluation. And so we expect companies are going to have to spend a little more time. So we're going to start you off with a polling question. And this will help us tailor a little bit what we do in the coming slides. But your question is, which following types of filers may see a blended tax rate for current U.S. federal income tax due? And we'll give you some time to answer that. And just a reminder, if you need to get CPE credit for today's webcast, you need to respond to at least 3 of the 4 polling questions we have in. And we only have 4, so you can only miss 1. And don't forget to hit submit. You need to make a choice of the selection and hit submit. Okay. So let's see what most of our group says. And so there's quite a few people out there that have been reading, or at least catching up on some of the releases. So the correct answer is B. A fiscal year-end company needs to come up with a blended rate based on how much time is prior to the date of enactment, or the effective date of the tax rate change, which is January 1st, and before that. A 1231 USC corporation is still going to use the graduated rates right up until the end of the year. So this new act really requires a revaluation of anything that's left after the current provision, which are your deferred taxes. So let's move on to the next slide and get into what this corporate rate change looks like. Casey?
Yeah, so commensurate with the previous example, rates will have quite a broad impact on most filers' financial statements, specifically with the reduction in rates. The act was signed by the President on December 22nd, 2017, which reduces the corporate rate to 21%, and this is effective for calendar year-end taxpayers starting 1/1/18. So when calculating current federal income tax due for a calendar year-end taxpayer, we're still looking to the existing corporate rates, which are primarily 34% and 35%. However, an interesting situation applies for fiscal year-end filers. To determine taxes payable, a blended rate would apply for non-calendar year-end companies for fiscal periods that include the effective date of the rate change. For example, a June 30, 2018 year-end taxpayer would apply a blended rate of 28.06 to its fiscal year 18 taxable income. The reduced 21% rate would then apply to all future years. This is because fiscal year-end taxpayers will look to IRC Section 15 when calculating the rate. The below chart is included to illustrate how a blended corporate rate would be calculated for various fiscal year-end filers with year-ends occurring in 2018. One interesting thing to note on the chart is that it assumes a 35% pre-tax law change period, but a different result could be realized if a 34% rate is used.
Yeah, so the idea here is that, well, two things. One, Article 15 that speaks to this says to use numbers of days, which is important if you have a tax year that 52, 53 week. That can change the number of days. So it's important to think about the days. They may not be material for a financial statement, but it is what the law reads like, and it is how you'll calculate the tax later. And so that's important. Many companies are going to be in the 34% bracket, and so really that needs to coincide with your expectations on how the payable will be calculated on the tax return.
Mm-hmm. Yeah, and for tax provisions, this is really more of a mathematical exercise. It's kind of easy to go through, but what we're unsure of now is how will this look on a fiscal year-end filer corporate tax return? Is there going to be a separate form where we do this kind of math, or are taxpayers going to rely on their tax software to do this correctly and then supply some kind of statement that produces with the return to prove this number out? And I think right now we're not sure yet.
Yeah, I mean, I expect the tax software will catch up with this, mm-hmm. But you have companies in the position right now with, say, a January year-end that are going to have tax returns coming up, and they'll need to know, at least for deposits, what they're doing and how they're paying. So it's an interesting question, and I'm sure we'll see a lot of development as we go forward, as far as tax form changes and maybe software changes. But this is the approach mm-hmm. that companies need to take if they're in a position of having a non-calendar year end.
While the tax law change will not have any interim reporting impact on calendar year-end filers, there are some considerations with respect to interim periods and fiscal year-end filers. For fiscal year-end filers using an annual effective tax rate to calculate tax expense, the rate change tax expense impact is a discrete item in the interim period, including the period and enactment. So in our previous example for a 3/31 year-end fiscal year-end filer, the 12/31/17 interim period will include the impact of this. When calculating the blended rate to be used for current tax expense, the fiscal year-end taxpayer will incorporate a pro rata allocation like the one included in the previous chart on the previous slide. However, another interesting situation comes up if a company is using the cutoff method for interim reporting purposes. And just as a reminder, the cutoff method has filers measure their deferred taxes at the period end of an interim period. If a company is using the cutoff method, consideration regarding deferred tax scheduling and blended rates on the deferred taxes will be needed. This is because some deferred tax balances may be realized on a long-term basis and could be scheduled to be affected by the 21% rate only. Other current deferred tax balances, which will be realized sometime during the current fiscal year end and will be subject to the blended corporate tax rate when used when calculating the current tax liability. These scheduling exercises can be complicated and often involve many assumptions. A detailed examination of the inventory of deferreds. Positions with respect to scheduling a deferred should be well documented to ensure financial statement auditors have a solid path to follow when evaluating this area.
Yeah, and I think on the effective rate, so the prescribed method under ASC 740 for interim reporting is to determine an annual effective rate and apply it to year-to-date income. And what's happening within this quarter is that the annual effective rate itself is changing. And so if you assume that your projected income is the same and each one is the same in the quarters, you've been going along and booking it at 34%, you'll have to book it at 24.53 or some rate that you determine as the proper effective rate. The impact of the rate change is a discrete item. Then if there's any change in your projections or year-to-date book income, that amount multiplied by the effective rate is your normal, non-discrete tax provision for the quarter. And we do see companies using a cutoff method. It's typically used where rates can be deceiving based on just the mechanics of how the rate is determined.
Yeah, or if the forecast may be inaccurate.
Yeah, the difficulty in forecasting. And so we do see companies using a cutoff method. And if that's the case, then you just need to consider what is discrete, what's not discrete, and how the company is accounting for that. So interim taxes are also getting impacted.
So we've been primarily focusing on current taxes, and we'll touch on deferred taxes here. The deferred tax assets and liabilities will be measured at the enacted tax rate expected to apply when temporary differences are to be realized or settled. At the date of enactment, deferred taxes need to be remeasured based upon the new 20% tax rate. And for non-calendar year end companies, scheduling will be necessary to determine which deferred taxes will reverse at which rate, which we covered in detail just in the previous slide.
Yeah, and that this is where companies will have I think, some difficulty, because timing differences that exist at the beginning of the year will be reversing in part during the year, but because of the blended rate, there will be two different periods that they could be reversing under. And so, the anticipation of that and booking the effects of that in this period will cause fiscal companies to have to schedule out how that's happening. And we'll walk you through an example of that we have. But this one we expect, calendar year companies, this won't be as difficult. Basically, all temporary differences at the end of the year will reverse at the future rate of 21%. But there will definitely need to be some scheduling.
Absolutely. And we wanted to note specifically for full valuation allowance companies that may have a hanging deferred tax liability or also called a naked credit, there's an impact on this as well. So just a little background, a naked credit or hanging tax liability is often seen as a result of purchase accounting. If a large indefinite-lived intangible asset is created through purchase accounting and has no tax basis, timing differences and expiring NOLs cannot be used to offset the deferred tax liability, resulting, even for a full valuation allowance company, in a deferred tax liability on its balance sheet.
And that's due to the fact that that's not amortizable for tax.
Correct.
And so therefore you've got an indefinite deferred tax liability, right?
Yep, and as with all the deferred tax assets and liabilities, the hanging deferred tax liability existing at year-end will be remeasured at the new 21% rate with a P&L impact to operating income. And that is true even if a company went through a recent transaction which resulted in this hanging DTL. Even if you're within the 12-month remeasurement period, this is an event subsequent outside of that transaction, and the remeasurement is just a P&L effect rather than any kind of hit to goodwill.
Yeah, and the item to note here is that net operating losses that were expiring, you may have operating losses now that don't expire; they're permanent, and so they can actually net against other permanent items, which would be your DTL. So now this may not be an issue for calendar year companies until next year. But we'll get into the net operating loss rules later that show you that this may in fact be an issue for fiscal year companies this year.
Mm.
So let's get into that example. Okay, so what we tried to do is put together a basic example. And, when we walk through this, we've got a calendar year versus a fiscal year company. And this is looking at how they're calculating their expense and what part we think is discrete. And so starting with the calendar year company, in 2017, we've listed 3 different timing differences, 2 that exist in 2017. And we did this to illustrate the 3 different ways that this can impact a fiscal year company. So for a calendar year company, you're looking at the gross differences. Temporary difference number 1 reverses in 2018. Temporary difference 2 reverses in 2019. And temporary difference 3 was created in 2018 and reverses in 2019. Now, if you follow the calculations down and look at your current taxes payable and the values assigned with the deferred tax liabilities, you'll see that they're valued at the beginning of the year at 35%, that they reverse in 2018 at a different rate. And so you'll see that they actually come down and result in an effective rate, as you would expect, since we don't have any permanent differences here, of the statutory rate at 21%. The same thing is true in 2019 for the calendar company. In the fiscal year, and we put some notes there to the right, the $30,000 that reverses in 2018 actually reverses before the end of the fiscal year. The timing difference for the $20,000, temporary difference number 2, actually reverses in 2019 after the fiscal year end, 9/30/18. And then temporary difference 3 is originated in 2018 and reverses after. And so the important thing here to note is that each one of those timing differences has a different impact. The timing difference number 1 that was valued at 35%, it actually reverses at a different rate, the blended rate. And so if you look down below and we're looking at the discrete tax effect, that rate differential is 10.47%, which is the 35 less the blended rate of 24. That's the discrete effect in 2018 for the remeasurement of the 2017 deferreds. For the timing difference that reverses after that, the full 14% is the differential because that's when we expect it to reverse at 21%. So this just illustrates that in order to measure the deferreds for the date of enactment, you need to know whether or not it reverses during the fiscal year that has a blended rate or a fiscal year after that that does not have a blended rate. One thing to note, and we corrected this on your slides that you'll be able to download, is that the tax expense reconciliation at the bottom should actually be a tax benefit. It should be in brackets because you're reducing a deferred tax liability from a higher rate to a lower rate. So there's a debit to the deferred liability and a credit to tax expense. So apologize for that, but we've got it corrected in your downloads. So another polling question for you. At what rate do we expect most calendar year 2017 U.S. corporate filers to use in calculating U.S. current federal income taxes due? And I mentioned the download. You'll be able to download those from the folder that says slide deck and handouts at the bottom of your screen. And we'll also be sending out that same slide deck in an email after the webcast today. Okay. We've given people enough time.
Yep.
Good. Well, we've got a couple different. Well, go ahead, Casey.
Yeah, looks like we have a couple different results, but as most have answered, 34 or 35% is the correct answer, and actually 15% could be correct too, just depending on a corporate income level and bracket level.
We still have the graduated rate, so
Yep.
somebody may actually be in the 15% bracket for corporate taxes due, so that's a fair answer.
Absolutely.
But we put most on there for our calendar, so we expect most to be in that 34 or 35% range. 21% will be for the next year.
Mm-hmm.
Okay, so AMT, Alternative Minimum Tax for Corporations, was repealed after December 31st, 2017. So it will apply for 17. But then for tax years 18, 19, and 20, that credit carry forward can get used against regular tax as computed, so at the new rate of 21%, and any remaining credit is eligible for a refund of 50% of that balance. So there will still be some amount carried forward, if not used to offset the regular tax. So they do that for a few years, and any remaining credit carry forwards are going to be fully refundable in 2021. So two impacts on the provision. One is if there is an existing valuation allowance on an AMT credit, then we need to go ahead and remove that valuation allowance because the law change made it fully refundable. There's also the classification question, and we've been asked this already. If you can compute the amounts and split that between current and non-current, it makes sense to do that based on your expectation for 2018 calendar year companies. And arguably, all the credits can be classified as a receivable, a long-term, to the extent it's not going to be received in the next 12 months. There are also views that maybe that second piece should remain as a deferred tax asset to offset future taxes payable when they are measured. But in any event, it is now no longer subject to a valuation allowance, and really a receivable is the right approach if the company expects a cash flow impact.
Mm-hmm.
Now, modified net operating loss deductions, this is where there is some confusion out there, and I think we have heard that a technical correction may be coming. But the way the current law reads right now, net operating losses arising in tax years, which is important, beginning after December 31st, are limited in their ability to offset income to 80% of taxable income. If they're for net operating losses that are arising prior to that, the old rules still apply, and you can offset 100% of income. Now, the second change to NOLs is where the confusion came in. The way that it's written, it says that NOLs arising in tax years ending after December 31st can be carried forward indefinitely, but you lose the carryback, the 2-year carryback. Now, for fiscal companies, that means that losses currently anticipated for a fiscal year that ends in 2018, this rule applies, and you can no longer carry back. But the carry forward is indefinite. But because of the language for the first change for tax years beginning after, that wouldn't apply until the 2019 fiscal year end for a 2018 tax filing. And so 100% of that indefinite NOL can get used. So you really have 3 buckets now for net operating losses. And until a technical correction comes in, we're going to have to consider that. And another note, just that the NOLs need to be measured at the applicable rate and, in fact, when it's going to be utilized, so the same sort of scheduling type consideration. They can also significantly impact the valuation allowance assessments, and this is because you now have a permanent NOL. Mm-hmm. And so the question becomes, was the previous valuation allowance a expiration that caused the NOL to go unused? And if so, maybe the new laws are going to change your evaluation. So just valuation allowances are impacted on almost all of these. So we'll touch on a couple of those comments. I mentioned that the pre-calendar 2018 NOLs versus post and the 80% utilization are going to need to be considered. There's also a few other things that I think are notable that companies are already asking about. One is the disallowed interest expense, which we don't dive into a lot of the details of the Act about how different things are dealt with, but for provision purposes, you've now got a carry forward that's carried forward indefinitely. And so how does that figure into your evaluation? Because that's a future asset. Your foreign tax credits, we'll get into this in the international piece, but this one right here, the evaluation on how that's going to get used and what the deemed repatriation might cause will need to be part of that consideration. Your capital loss carry forwards, the old rules about offsetting with capital gains still apply, and so that's an issue for companies that may have them expiring. One item to note is that the capital treatment for self-created property was changed under the new law, so it's no longer a capital asset. So there may have been tax planning strategies out there that companies were taking advantage of that allowed them to recognize the benefit, but may no longer be available. And as far as tax planning strategies go, in general, tax planning strategies only apply when their actions an entity might ordinarily not take, but it would prevent a deferred asset from expiring unused. If a deferred asset doesn't expire, it doesn't meet this definition. So tax planning strategies may not be available for your indefinite assets. So just another consideration when you're going through the evaluation for evaluation allowance. So along those lines, we'll add another polling question in here. 382 is the provision that limits your NOL to a specific amount if you were purchasing an NOL as part of an acquisition, or a change caused by your equity limits your NOLs. But question here is, what should a 382 reserve currently booked against deferred tax assets occurred before the calendar year? What should be done there? And we've got several companies that have this situation. Mm-hmm. So we bring it up because the questions are already being asked, which are good questions.
Absolutely.
So we'll advance that one. And the majority of the group got it right. There should be no change because a reserve is based on the mathematical formula that limits the amount of income that an NOL can offset. And that offset, that NOL, will still be in 100% NOL because they're historic. And so they retain their 100%, but they also retain their expiration. Mm-hmm. And so 382 did not get changed by the tax law, so you can't remove it as a limitation. It was unaltered. And you wouldn't use a 21% rate. These were numbers put in there to see if there might be some confusion here, and there is. And the 382 limitation may be impacted by a number of other things going on that require a change in the projections. You may end up shortening your income, and therefore maybe they're expiring unused. That could be an impact, but nothing along these lines as far as these answers go.
Yeah, and on a go-forward basis, for years arising after this year, there will be different considerations now when looking at 382 and NOLs, considering that future NOLs just won't have an expiration period.
Yes.
So.
for sure, and not for the current ones. So international provisions, I think we wanted to touch on a few things here, and the reason is there's some urgency here with regard to getting after some of these issues. So they made some fundamental changes in the way that foreign earnings are taxed, and like I said earlier, we've got a webcast to dive into these details because they're very specific to companies, and they are definitely part of a strategy that the company needs to review. There'll be a current impact, but then there's also a larger question as to what will be done in the future, and that can impact your provision. So basically, they changed principally to a territorial system, and what that's doing is it's requiring a repatriation of earnings that already exist outside the U.S. And because of that, there will be less basis difference in those outside companies, outside investments. So the idea of the indefinite reinvestment is the companies didn't book a liability, a deferred tax liability, for unrepatriated foreign earnings if they could say that they're going to keep them outside the U.S. That number simply might be going down given, the new calculations for the company. So that indefinite reinvestment assertion is a question that should be answered in the period of enactment. Many companies, I've seen some different polls, but they've decided that since they're being taxed, they're going to go ahead and bring some cash back. And so those need to be reviewed. And the companies will still need to make that evaluation. I mentioned the repatriation. It's also called a toll charge. And the important thing to note here, not getting into the measurement too much, but in the period of enactment, in this period, the company's going to have to record a payable for the toll charge, whether or not they choose any of their options to either defer or delay payment. This is a measurement question as to what tax now exists on that earnings, on those earnings. And any tax payable it needs to be allocated between, current and non-current. There's an 8-year period over which companies can choose to do that. And so there will just need to be a determination as to what companies are going to do with their cash flow there. And so that's on current earnings and accumulated earnings that haven't been repatriated. There is also a new tax that was introduced as part of the base erosion and anti-tax abuse regime. This has been discussed quite a bit. It's really aimed at domestic corporations that significantly reduce their U.S. tax by making large deductible payments, such as royalties or interest, to foreign-related parties. And so what it does is it takes those kinds of deductions and adds them back and applies a rate so that companies can't avoid the U.S. tax and drive their otherwise 21% rate down. Now, this may require companies to figure out whether that changes their effective rate for the future in a way that it makes sense to then apply that rate to the deferreds rather than a different rate, a lower rate. And so, and we have this situation now, I think, in Mexico where there's 2 different tax regimes, and companies can go in and out of this depending on their situation. And so it really is a decision to be made whether or not this is a incremental tax in a period that's not expected to recur and accounted for as, a period tax, or whether it's a situation where the company expects to be in it for the foreseeable future, and therefore their timing differences should have a different value to them. So once again, without getting into a lot of the mechanics, which are the subject of a full, I'm sure a full day study and other webcasts, the impacts on the tax provision need to be considered. And both the rate on deferreds and the actual calculation of what might be due and when it's due are the impacts we're trying to note here. So along with that, just a couple of comments having to do with foreign tax credits. When companies are required to bring back this money and incur a toll charge, they're allowed to use foreign taxes that were paid on those earnings to offset that. Now, the law has a couple different ways that toll charge is calculated, but because it's allowing a deduction to reduce it from what would otherwise be a 21% rate to a lower rate, that rate's 15.5% on some parts of that income and 8% on others. What they're going to do is also reduce the amount of credit that you're able to use against those that income. So even if there's foreign taxes that have been previously calculated and determined to be creditable, the availability to offset the income may not be the full amount. And of course, as we note here, there's also foreign taxes that aren't eligible for a credit. So just keep in mind that the foreign tax credit calculations can be involved. So we need to look at that. The credit carryover period for foreign tax credit remains unchanged at 10 years. And another item to note is that companies with net operating losses can use those to offset this income when included in their U.S. return. They could also elect out of using their net operating losses if, in fact, they wanted to use credits or have those losses preserved for some other reason. So there's a provision that allows companies to choose not to use their NOL to offset the tolling charge. And again, it would be a company-by-company type consideration. So just a couple items to note, and again, we've got a webcast coming up for international that will cover a lot of the specifics on how you get to these numbers. But these are the impacts that we think are important for the tax provision. And so our last topic that we wanted to cover is financial statement disclosures. You know, the public companies have already been provided guidance that say that there's the expectation that their management discussion and analysis area of the financial statements, the MD&A, that's going to contain some explanation as to the impacts and risks or other uncertainties with regard to the passage of the Act. The footnotes are what I wanted to point out here, in that the standard footnotes still apply, the requirements for under ASC 740. However, the SEC provided the staff accounting bulletin I mentioned earlier that says that if you take a provisional approach and you put in estimates, you need to provide in the footnote these items here. And when you go through these, you can see that they're fairly specific with regard to which items were provisional, whether or not you were able to provide a provisional amount, and if not, what those items were, the reason why an initial accounting is incomplete. And for many companies, this is going to be, inadequate time and resources to, enable a full calculation of the impact of the Act. So I've yet to see a disclosure come out, but we should be seeing them shortly, and we've got some suggested language that we've been discussing with companies. And then also information about what it's going to take to get the rest of the information to complete the accounting requirements, and the nature and amount of any measurement period adjustments. I didn't mention that if it's provisional, they have a measurement period after the financial statements in order to get that correction made. It can't be longer than a year. And so somewhere in that future period, measurement adjustments are going to be recognized. And the nature of those and what they are will be disclosed. And then finally, a statement as to when the accounting for the income tax effects has been completed. So there will be no more future adjustments, and after that, everything is under the new act. So fairly robust changes, and I expect that public companies, many will have this. There will be some, I'm sure, that can fully comply with the calculations, but many will have trouble, and therefore we expect to see this.
Mm-hmm. Yeah, and there's an impact too just on the existing disclosures in the footnotes. For example, we're already getting questions, let's say, from a public company fiscal year 18 filer who will be using a blended rate for current taxes, remeasuring deferred taxes, and also accounting for the just impact on the deferreds of the change in law. All those can have a different effect on the rate. Do we lump them all together? Do we separate them out? I don't think the guidance is very clear on that right now.
Well, the existing guidance will apply. And so for your rate example, significant items as a function of the effective rate used to be 5% is the commonly used amount, 5% of 35%. So one thing to think about is that's dropping in future disclosures. If they're under a 21% rate now for the statutory rate, 5% of 21% is lower. So your significant items may become smaller.
Yeah.
And also, we don't know yet, but companies may combine the impact of the entire tax law change into one number, or it might be meaningful to break those out if it has other ramifications in the financial statement. So that's yet to be seen. But the questions are fast and furious. So we have one last polling question here for you, and one that we're interested in. Which of the following will have greatest impact on your tax provision for the coming financial statements? And we'll give you a little time to sort through that. And we've got some questions coming in that we might get to after our summation, but let's see where the answers came in. So not surprising, I think this is where we get a lot of the questions and why we led off with some of the mechanics. The changing corporate tax rate. International, I actually expected, but you never know who's calling in, so I thought that really is a complex area that a lot of companies are going to have to deal with. A valuation allowance for certain. We'll definitely have those discussions. And not surprising, it's hard to tell yet for a lot of people. So good information, and what it speaks to is really just there's a lot of work to do. So we wanted to give you some key takeaways, both just high level what we covered, and also some things to think about as you head into the reporting period. One is, as mentioned earlier, the President signed the bill on the 22nd of December of 17, and so provisions within that incorporate that have to assess the impact and measure that impact. And that's both on current taxes and deferred tax assets and liabilities. So again, fiscal year filers are going to have just more work to do, I think. And that discrete adjustment is reported separately from your provision. And that's important for interim reporting and for disclosures that will need to explain the impact of the tax reform. And scheduling and timing differences, many companies are going to have to do this. So significant additional time and resources may be necessary. And this is where we're having a lot of conversations right now about how much needs to be done for the provision versus how much more will be done later, and that, we'll true up estimates and we'll do tax returns. And so figuring that out now and making sure you have the right resources and time lined up is important. The other is valuation allowance. Lots of different impacts there for forecasting and everything. So really need to take a look at the specifics with regard to the tax law. You may need additional resources or processes or outside advisors or consultants. So those are all things that need to be identified and scheduled ahead of time. I've already heard from a few companies that are going to have just difficulty in trying to arrange for resources. So it's one thing to consider. In particular, if a company is subject to financial reporting controls, so internal controls over financial reporting, changes to those internal controls need to be documented and need to be part of the company's planning. Again, documenting all those positions thoroughly and making sure that there's calls with external auditors. If you've got provision teams that help you with your provision, just getting all that coordinated and making sure that documentation's available and in the form that will be usable to the others is critical. And then finally, financial statement disclosures and MD&A for both public and private. They're going to be more robust just because of the level of uncertainty and how companies are going to differ in how they approach this. And so there's continual guidance. Like I said, the SEC's already provided that with Staff Accounting Bulletin 118. The FASB's meeting today on some of the same issues. And so there will be regular releases and guidance and interpretations coming up. And so the other thing to do is just be aware of those. So I will turn that back over to Emily after checking just a couple of our questions here. Casey, you've got one in there that I saw that was a good one.
Yeah, so first question really relates to financial disclosures in the statements. Let's say we have a fiscal year-end 9/30/17 filer, but the audited financials have not been completed as of the date of enactment of tax reform. How is that, if at all, disclosed in the financial statements? And is it a subsequent event? And the answer is probably yes. It depends. It really depends on the materiality of the impact of tax reform on that filer, but yes, the impact of tax reform could be covered in a subsequent event disclosure, and the robustness of that disclosure would depend on how large of an impact there is.
Yeah, and we are just about out of time, and there are questions coming in. So what we'll do is try to answer those after, but wanted to thank you for your time today. And if there's any questions or comments, you can reach out to us. We provided phone numbers and email addresses, so please use them when you can.
All right. Thank you, Andy and Casey, for a great presentation today. As our presenters mentioned, we do have a lot of questions coming in. Feel free to keep submitting questions or reach out directly to Andy or Casey. We'll do our best to follow up with you after the presentation. And we invite you to join us for one of our upcoming tax reform webcasts. You can register for these webcasts and learn more about tax reform in the links in the slide deck and handouts widget, which is to the right of the slide view. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.